Hello and welcome to the latest RSM coronavirus webinar. As part of our Reactivate and Reimagine webinar series, we are looking at alternative ways of protecting businesses, generating cash and streamlining operations. One way of doing all of this is via re-evaluating what is core to your future business needs and realizing or divesting non-core operations and activities. And this is the topic area for today. Before we get underway, though, just some housekeeping announcements. Everyone has been centrally muted, but please do put yourself on mute to avoid any background distractions. And in terms of distractions, as all our presenters are home working, I will apologize now for any background interruptions or distractions or technical glitches, and should any such issues occur, I'm sure you'll all bear with us. The slide deck that you will be seeing will be made available later to delegates, and we are also recording the event, and a link will be made available to all of you that stay the duration to the end of the event, and that will be available soon after. Please also visit our coronavirus hub for recordings of our other related webinars on the CBILS, the job retention furlough scheme updates, outsourcing alternatives, technology, and private equity funding during coronavirus. So visit rsmuk.com for details. Now, we do want your questions for this session, so please do use the Q&A function, as you can see on the screen, as to where to go. I will endeavour to ask the panel as many of your questions as time allows, and we will be concluding at 3 o'clock sharp. In terms of your presentation team today, I'm Simon Hart, your host, and I'm delighted to introduce Kirsty Samwell. Kirsty is the RSM head of our National Corporate Finance and Restructuring Advisory practice. She's an M&A and private equity transaction specialist and has been a partner of mine for more years than either of us care to mention. John is a financial due diligence partner with over 15 years corporate finance experience, but with a specialist focus on divestiture advisory and complex carve-out transactions. Cal is one of our corporate tax partners who jointly leads RSM's National Transaction Tax team. Welcome, Cal. Next up is David, who's a partner in our technology and consulting team. David has a grounding in industry, having worked across many sectors and large industries, including Rolls-Royce and Cabot Schweppes. He has worked in private, listed, and private equity-backed entities. And Charlie Barnes, last but not least, is an employment lawyer within RSM's People Advisory Service team, where he advises buy-side and sell-side on employment legal aspects of a transaction. So let's look now at what we're covering in the next hour. We'll start with the obvious question of why divest non-core operations and assets. Some reasons may be less obvious than others. Then we'll hit the question of why now? Why in a global pandemic could this possibly in a month of Sundays be the right time to sell? Once we're over that hurdle, we'll get on to the more practical areas like, okay, I get it, but how do we go about that whilst in lockdown? And then we'll close with your questions. So before I hand over to Kirsty, I would just like to perhaps ask Kirsty a first question. You know, at a time when the Chancellor today announces an employment protection plan, a kickstart program for youth employment, plus there's CBILS, there's the CJRS until 31st of October, and a job retention plan, surely that's enough to keep businesses busy. You know, why need to divest assets, Kirsty?
The reality is that it takes time to get a business ready in whole or in part to sell. And so if you wait until the moment that perhaps you have to, actually you will suffer enormously in terms of value and what can actually be achieved. And so with every transaction, I think all of my colleagues here will absolutely say, you know, time to prepare and to think and understand your options is fundamental, so that if something happens, which means you have to, or you decide that you need to, you can do it in your time rather than at the time of someone else's choosing.
Makes perfect sense. Thanks, Kirsty.
So should we go to the first slide, Becky? Thank you. So for sort of the why divest non-core assets, I think pretty much every business leader right now, we certainly are, you know, obviously within our own business, is looking at the sort of what does this mean for us in the future. The plans will have changed, plans will have accelerated, and for some businesses, sort of the unthinkable things which would never have been on the agenda are now part of a new norm of the way that we're working. And against that backdrop, to get through the pandemic, actually a lot of businesses will have needed to take on loans, C-bills, as we've mentioned. They may have deferred VAT payments. And so what we will see towards the end of this year is actually some balance sheets which are pretty over-levered. And just at a moment when you're trying to kick-start your business, a real need for working capital, and there are some businesses where actually opening up is going to be a real strain. It could be, those are sort of the downside reasons why something which generates cash is fundamental, but it could simply be that there are pieces of the puzzle now which, in a different time, a global expansion, a new service line, or some other investment, whilst it looked good and the decision was made 18 months, 2 years ago, actually against what is the new normal, that is now no longer core to your strategy. And if it is non-core, rather than let it wither and sort of dwindle on the vine, actually can you be more proactive and extract value for those decisions rather than just sort of slowly let them decline. And then there are some bits of lots of businesses where on the face of it, it generates contribution, but actually the senior leadership time involved in making those businesses tick is disproportionate to the value that they bring, perhaps because it doesn't sit well within the rest of the organisation. And at a time when so much change is coming at business, is now the time to actually try and relieve some of that management burden. The last point on this slide I find is probably something which people will be surprised about, but receiving an approach from an interested buyer is often the first time people think of either selling or divesting anything. And thinking about what could be sold and preparing means that if that does come up, you can grab hold of the opportunity. But actually, a lot of people really think about it at the moment they are approached from an interested buyer. As we'll talk about later, you will be surprised there are actually a lot of active buyers in the market. So thinking about what are the reasons why we might, if we just move on to the next slide, what are we talking about with a non-core asset? So it's easy to think, oh, it's a subsidiary, it's a business which does something completely different to us. And probably the cleanest deal is a business which is a subsidiary which sort of acts almost independently to the business as a whole. But a divestment actually moves throughout the sort of the chain of the business. It could be that it's a business because it's in a certain geography. Probably the most common that John and I see will be actually a specific division or a product or service line. If you're a business which has premises, clusters of sites, perhaps actually expansion into certain parts of the country is now not core to where you are, and you want to consolidate, and so it's better to pass those assets on as trading assets to another party. And then right at the smallest end, and you see this, I suppose, in people-dominated businesses, a team or a function, all of these you can secure value for as a sale of an asset, as opposed to a closed down a team or function. You don't just have to let people pass on for sort of to a recruitment, as a sort of a recruitment transaction. So it's just to keep in mind that for everything, it's a wide array of type of business and type of deal, but they do have some common areas that you need to contemplate as you go through. So our next slide is sort of why now. We touched on some of those, and the next slide, Becky, please. So why is now a good time to consider a divestment? And Simon's absolutely right. The government is pumping money into the economy to get us going again and to support businesses through it. It's easy to think that actually a global pandemic, that this must be like 2008, that the deal environment is dead. But the reality is this is not a financial crisis as we saw in 2008. And whilst deal volumes have definitely dropped. Actually, the story is very different sector by sector, and what there is not is a credit crunch or a lack of financial capital. And what we have seen is businesses which are attractive to private equity. Actually, that market is incredibly buoyant. We recently did a survey with the mid-market in the UK, and where actually they are expecting more and more activity this year. And what you actually have is a market where there's a trillion of uninvested capital, which has to be deployed, and it has to be deployed in acquisitions. So we just have the next slide, Becky. So we've touched on this. So you have options across different sectors more than others. A pure trade route in some sectors may not be open to you, but there are always strong parties. Private equity, significant dry powder, definitely a place that you would be looking. If your asset is attractive to private equity, you will get a lot of interest. And then sort of the bit which people don't understand is how much private equity is already invested in the economy. And actually some of the most active acquirers in the mid-market are businesses which have already received funding from private equity. They're what we would call a platform deal. And those businesses are actively out looking to grow. And some might say some of those deals are opportunistic, but actually because there is so much money, what we're finding is competition for good deals and things which are strategically important actually still do fetch prices. So don't think that a divestment is necessarily a way that actually it's to offload something to an opportunistic buyer for a cheap price. Some of those deals obviously will be there, and that might be fine, because for all the reasons why you need to sell it, that is also fine, because the cash is more important than the final price. But there is definitely acquisition appetite in the market. And I suppose my overriding thing is, why is now a good time to consider divestment? In all of the strategies and your COVID-19 planning about how you come out and how the business is future fit, divestment must be part of your strategy. So it's not just now, but it should always be considered along with all the other measures that you will be right now. So we're just coming on to the next slide. So I have touched on some of this already, but there is a difference. So what makes an asset attractive? So overarching all of this will be how well prepared and packaged it is and ready to be sold, because that does enhance value in every deal. But there are certain things within the business which will help. How COVID resilient has the business been? You can probably imagine COVID resilience is makes a business very exciting to buy right now. But that's if it's not, that doesn't mean that it's not sellable or that it won't fetch adequate value. How separate is it from the rest of your business, and how easy to separate is it? How big is it? Scale does help in terms of value and interest. What are the quality of earnings? Is it underpinned by contracts? Can those contracts be novated? How well does it fit within a buyer's operation? So what might be sort of a carbuncle for your business might be the jewel in the crown for somebody else. So how well do you know it, and do you know the market that it operates in? And whereabouts would it sit? What can you lift and shift? So whilst it might be quite embedded, does that mean that when a buyer owns it, they are actually being able to leave behind significant head office costs, and they are buying contribution, so it is much more profitable, a piece of acquisition in their hands. And then finally, and something which shouldn't be underestimated, what's the quality actually of the management team? Can they, if it's a truly independent business, can they run it? Are they strategic? Can they do that without head office support or larger group strategy input? Or can they bed in and prove themselves within a new organisation? Because a business which isn't just a list of contracts or product, but actually comes with a wrapper with people who have a strategy and can drive it forward, will be more valuable. So just moving on to the next side. How do you go about it? So selling part of a business, the general rules are the same as you would for selling anything. You know, you prepare, you package and market, and then you project manage to close. And throughout all of that process, you are either preparing or actually negotiating right down until the money is in the bank, and you manage those negotiations with your advisor and your team. As part of that, what is true in every deal, but in particularly when it's a carve-out, there are a number of conflicts which will be thrown up with the business which is being sold, the management within it. There is a big piece to manage around confidentiality, who in the organisation should know, who outside of the organisation should know, and what happens if it leaks in either of those places and you don't want it to, and then how do you manage the communications with your team and to the market. Now that is true in any deal, but in a carve-out you are adding tensions because you have this piece of bits being left behind and bits going forward, and so there's even more to manage there. But for any deal, and we'll go into more detail, the preparation stage is absolutely key. And that starts with you as business leaders deciding absolutely what is it that we need to achieve if we're going to go down this route. What is fundamental to us? Is it a pound notes of cash? Is it we need to be free and clear? Is it we don't want that brand associated with us anymore? And what are your red lines? And part of the preparation is to absolutely understand that, and also understand what impact the divestment will mean for the business which is left behind. So the preparation is a very detailed phase, and understanding those red lines actually impacts the who you can approach and what it is that you can divest. So I'll hand over now to sort of the more technical pieces of how you prepare and the things which you need to understand in order to work out if the divestment is for you. So, John, I think over to you.
Yeah, thank you very much, Kirsty. I guess by way of introduction, to succeed with a potential divestiture, prospective buyers will need to be able to accurately assess the carve-out business being sold. On this slide, we've set out the likely key areas of consideration for a typical carve-out transaction. I'd like to start with the transaction perimeter, please. This is the first step to define. And what does this mean? Well, in simple terms, it's a case of what is in and what is out of the transaction. As Kirsty mentioned previously, there may be a natural perimeter, e.g. existing legal entity or subgroup, which fully encompasses the assets or operations to be divested. However, more commonly, there will not be a natural transaction perimeter, e.g. the assets or operations being sold may be distributed across multiple legal entities and combined or blended with assets and operations not being included in the transaction perimeter. In all cases, establishing a clear carve-out perimeter and legal entity structure will be absolutely essential. In terms of the financials, once the transaction perimeter is defined and established, the preparation and presentation of a robust set of financial statements and information will be required. Key to maxing the value of your divestiture and underpinning the overall equity story will be a clear articulation of the historical and forecast trading drivers together with the cash generation profile of the business. Carve-out financial information may not have historically been reported out separately and will usually not be subject to specific statutory audit. This being the case in such circumstances, the provision of a clear audit trail and anchoring to group audited financial statement will be an important hygiene factor for the robustness of the carve-out information provided to bidders. From our experience, particular complexity is often encountered with respect to the presentation of working capital and cash generation information. Detailed work is often required to prepare illustrative historical balance sheet and cash flow information in circumstances where discrete nominal ledgers will not have been maintained. Both of these being areas that are critical in terms of striking leading to equity value and also for bidders understanding the level of returns they'll get in future funding requirements. Moving on to head office costs, to assess the value of the carve-out business, bidders will also need to gain a deep understanding of the level of entanglement and reliance of the business with the wider group from a financial perspective. This can be including and not limited to the head office infrastructure and leadership team and reliance on shared services, typically including finance, marketing, IT, and legal teams, etc. There can be reliance on group procurement with respect to agreed supplier discounts and rebates. Key question for bidders here will be, can gross margins be maintained on a standalone basis post-transaction? And finally, the benefit of the carve-out business being part of a wider group from a branding perspective will also need to be considered. In terms of normalised earnings, as with any transaction, the presentation of normalised earnings will be a key area of focus to help bidders calculate their valuation. Our work will focus on helping to maximise the reference earnings presented, whilst most importantly maintaining credibility. With respect to the head office costs mentioned and group services, the approach we take here will be driven by the likely buyer universe for the transaction. For a sale to trade or PE-backed trade, we can often seek to present the business at the contribution level, e.g. pre-head office costs, on the basis that the purchaser will form their own view as to the extent additional cost and infrastructure is required to absorb the purchase asset within the buyer group. Whereas for a private equity platform transaction, the acquirer will not necessarily be acquiring everything they need to keep the business going on its own, and a more detailed assessment of additional costs to run the business on a standalone basis will be required. The degree of services also required under a transitional service agreement will also be higher typically under a private equity platform transaction, and the team will come on to discuss that shortly. At this point, I can hand over to David to talk through considerations from a technology perspective.
Thank you. I'd like to just go over the technology aspects of a sale and demerger. There are often quite a lot of areas that need to be covered through the technology strand. It depends very much on the type of business that you are divesting. If it is closely coupled, there will be significant amounts of work. If it's loosely coupled, there may well be a relatively small amount of work. The first aspect to think about is the pre-sale activity. And quite often, as a very minimum, this means articulating the asset base for a potential buyer. So they understand what IT assets may be transferred or what complexities there may be around separation. This needs to be expressed in a way which is as positive as you possibly can make it, obviously, but at the same time being practical and down to earth. But in addition to that, there is other work that you can do in preparation, which are to do with partly maximising the value of what you have at the moment. So there may be quick wins that you could execute. We don't mean the equivalent of replacing the bathroom in your house before you sell it. You can't really predict what the buyer will want to do with the business. So what I mean is making sure that it has tangible financial value if you're going to make any changes. But in addition to that, you are looking to the IT infrastructure to see where there may be risks or additional costs to the purchaser which you could mitigate before the point of sale. And on top of that, prior to sale, you may wish to consider or restructure the contracts you have with IT providers to make sure that not only can you increase the scale of IT provision if you decide to grow your business, but in this particular case, if you shrink the size of the business, then you do want your IT contracts to shrink in proportion to the reduced scale of the business. More often than not, when we're making IT purchases, we're looking to scale the business up and we don't really think about the downturn. The second part is about carve-out planning. The retained business may well be a significantly different shape to the business prior to the sale. And so you may wish to consider what the target operating model for the retained business looks like. And this would include products, services, branding, routes to market, operations, facilities, and so on. And the reason I mention it here is because that target operating model strongly influences the technology model that you will need to operate the business in the future. And you may well be switching off components of the technology post the sale or transferring that technology to the purchaser. And that brings me on to the next stage, which is the transitional services agreement. Quite often, as part of a purchase, the purchaser will be acquiring technology or parts of the IT team, as well as other parts of the business. And as part of this, this can take some time to fully embed that new service into the acquiring party's business, and therefore they are looking to you as a seller to support them during that period. Now that period may be anything from as short as 3 months, but I have seen carve-outs take as long as 2 years, and they will be expecting you to provide support for that period of time. Once the sale's been agreed, then there is usually an initial separation activity. And this usually means IT networks, email addresses, website domains, and so on will need to be transferred very, very quickly. The acquiring party will need to separate their business from yours, including any branding, almost immediately, certainly within 30 to 90 days. And that means that your own IT department needs to be fully on board with the sudden uptick in activity that's going to be required to execute that. Following that initial period, then you are going to start to look at implementing your target operating model and the new technology model for the retained part of the business. This may mean implementing a simplified IT infrastructure, simplified software modules, and you will be looking for cost reductions during this phase. And all of these activities, when you put them together, means that there will be stresses and pressures on your IT team, whether that IT team is internal or outsourced, and all of those pressures need to be managed during this period of time. So with that, I'll hand you over to Charlie, who's going to talk about people.
Thanks, David. So when it comes to the people part of the deal, one of the key considerations is the transaction perimeter that was explained by John. Are you selling assets or a legal entity? If it's an asset sale, TUPE will apply, which has certain implications in relation to the employees who are assigned to those assets being sold. And TUPE provides protection for those employees so that they cannot be dismissed or have their terms of employment varied because of the sale. Their employment should effectively continue as it did before. There are exceptions to this, but only in certain circumstances. For example, if the buyer wishes to make redundancies or the sale requires a change in the place of work. Under TUPE, both the buyer and the seller have certain legal obligations to comply with prior to the sale, although most fall on the seller. These include providing certain information to the buyer and the employees who will be transferring. If a legal entity is being sold, on the other hand, TUPE won't usually apply. However, it could if at some point around the time of the transaction, there is a transfer of assets into that legal entity. An important and sometimes forgotten aspect of the deal is identifying which employees will be sold with the business. If a legal entity is being sold, that should be fairly straightforward, as the employees should be employed by that legal entity. On an asset sale, though, the seller will need to determine which employees are assigned to the part of the business being sold. Some may be easy to identify, perhaps because they are solely responsible for delivering the service of that part. Others may be more tricky. For example, managers and support staff may not necessarily devote 100% of their time and effort to that part of the business. It may be shared across other divisions or departments. In those circumstances, the seller will need to decide whether they are assigned to the part being sold. Now, there are legal considerations to determine that, but there are also commercial ones too. If they were assigned, could you be losing a valued employee or a unique skill set which you would be better off retaining? If they weren't assigned, could that affect the buyer's perceived value of the business? Once a buyer has been identified, if possible, it's helpful to understand their intentions regarding the people who they would be taking on. Not only will this shed light on what the people aspects of the deal might be, but it will also give the seller advanced warning of what it may need to inform and consult with its employees about. Employees can also impact the deal because they have the legal right to object to a TUPE transfer. If they do object, they're treated as having resigned from the business on the date of the sale. If there are key employees whose skills and knowledge are crucial to running the business, buyers will want reassurances that those employees will transfer. Sellers may therefore need to consider how they will get those employees to buy into the deal and the benefits of it for them. Kirsty touched on this though, and that's the point, that sellers do need to be careful about which employees they share information with about the deal in the early stages. That could lead to commercially sensitive information being leaked, or employees being unnecessarily spooked about the prospect of a sale. I mentioned before the legal obligations a seller must comply with under TUPE, and these need to be built into the time frame for the deal because they can take some time. And the first of those is that at least 28 days before the date of the sale, the seller must provide the buyer with the employee liability information. And this is a list of information concerning all the employees who are transferring, such as their identity, age, and their terms and conditions of employment. And if this information isn't provided, it exposes the seller to the liability, to the possibility of a claim from the buyer if they suffer any financial loss as a result of that, or if there is any inaccurate information provided. All of this information needs to be collated in good time to ensure that that 28-day deadline is met. The second obligation is that the seller must inform and consult with the transferring employees about certain aspects of the sale, for example, when it's taking place, why, and whether the buyer intends on making any changes to their working conditions which may affect them after the sale. There's no set time frame for when this consultation needs to take place, but it must be done in good time to ensure that it's meaningful before the sale. What a seller needs to consult about will depend on what the buyer's intentions are, and the buyer is therefore under a legal obligation to provide this information to the seller before the sale. It could be nothing, in which case there may not even be a need for consultation, but if drastic changes might be intended, such as redundancies, this will require more time to carry out the consultation process. If at least 10 employees are being sold with the business, the seller may also have to hold elections to appoint representatives for the purpose of that consultation process, and that cannot commence until those representatives are in place. And if any of those steps aren't followed, then that could also expose the seller to the possibility of compensation claims from all of those affected employees. And the final point I wanted to touch on is that in preparation for a sale, sellers should try to collate and get in order as much information as they can that a buyer will be seeking as part of the due diligence process. So from a people perspective, this would include information relating to the categories of employer and worker they employ, contracts of employment, staff handbook and policies, and certainly pay and benefits and holiday entitlement and accruals. Having this information complete and ready means you can identify issues which are likely to crop up during the transaction, and these can either be tackled now or factored into deal negotiations so there aren't any hidden surprises. Buyers will usually be on the lookout for serious issues concerning national minimum wage, holiday pay compliance, and more recently the job retention scheme, and all of these can have an impact on the value of the business. I'll now hand over to Cal to discuss some of the tax aspects.
Thank you, Charlie, and good afternoon, everyone. Tax usually plays a key role in any carve-out transaction. Over the next few minutes, I'll consider some of the things a vendor should address pre-deal in order to get the deal done quicker and to enhance value for the buyer. There are two main areas. The first is the process of considering upfront what issues or concerns might be identified or raised by potential buyers when they carry out their due diligence. This would form part of any vendor assist work. Quite often, value can be lost when sellers fail to act to clarify and potentially mitigate any tax risks before the process starts. So sufficient time should be given to identify and address those risks, and also to build in defences to support any tax uncertainties that will need to be managed as the negotiations progress. A vendor might need to undertake some form of pre-deal structuring as well, so to package up a number of non-core assets for sale, which might include assets held in different companies and sometimes a combination of UK and overseas assets, or perhaps to separate the assets to be divested from assets to be retained where they sit within the same corporate entity. So this might be certain divisions within the same company, or maybe a selection of hotels or restaurants to be divested with others to be retained. Any pre-sale structuring of this type should also therefore be considered and addressed as part of any vendor assist work. The second area of focus for vendors is to consider possible sale structures and the tax consequences for both the seller and the buyer. This will help the vendor assess how the different options might impact on the post-tax value of the deal for the buyer. In a corporate carve-out transaction, commonly a buyer might favour a trade and asset deal, They're not acquiring a company with its corporate history, and this should receive a step up in the tax base of the assets, including any intangible assets. A vendor might often prefer a share sale. For corporate shareholders, looking at disposing of subsidiaries, a share sale might be driven by certain disposals of trading businesses being exempt from tax under the UK's substantial shareholding exemption. For privately held companies, this can be down to the availability of entrepreneurs relief, although that's been reduced a lot, and also in avoiding having two layers of tax. Firstly within the company on the sale of the business, and then secondly when the value is extracted into the hands of the shareholders. So this tension between the vendors and buyers' favoured sale structures will need to be managed. Thankfully, over the last few years, we've seen some welcome changes and relaxation to the tax rules governing corporate disposals, which lends itself to a third option. You can now achieve an almost similar trade and asset type tax outcome for the buyer through a share sale. It applies where the substantial shareholding exemption would otherwise be available to the vendor on the sale. The way it works is prior to the deal, the vendor hives out the trade and assets to be divested into a new co. Vendor then sells the shares in new co to the buyer. Vendor claims the substantial shareholding exemption on the disposal, and buyer acquires a clean company and gets a step up in the tax base of the assets when NewCo leaves the vendor's corporate group. However, it's really important to note that the step up in the tax base doesn't extend to any intangible assets, and this is where the pre-sale hive-out option falls short of an outright trade and asset deal for the buyer. This option only works where you have a corporate group to begin with as well. So if you have a singleton company held privately, you might need to consider alternative planning options like a demerger. But the key message here is, addressing possible sale structures early with buyers, to ensure there's enough time to actually package up and hive out any assets prior to a sale. Tax attributes such as accumulated losses, are also often considered as part of the negotiation to try and enhance value for the buyer. With both trade and asset transfer or pre-sale hive-out option, only trading losses will actually transfer with the business. So if there are excessive non-trade losses or disallowed interest costs under the UK's corporate interest restriction rules, these will remain with the original company. The only way to transfer all the attributes to the buyer is to sell the shares in the original company. And there are ways to achieve that in a carve-out scenario, but there is a trade-off between transferring the tax attributes and the buyer still getting a step up in the base cost of the assets. Additional tax attributes might also arise as a result of the transaction, and these shouldn't be overlooked. So, for example, are there any significant pension liabilities for the vendor on separation, or swap break costs arising as a result of, maybe early terminating certain financing arrangements, and also thinking about any intercompany balances that will need to be cleared. And the key point here is, there could be options to use some of these additional attributes to reduce the buyer's stamp duty costs, and also to allow them to benefit from the tax relief that might be available for settling some of these liabilities as well. My final point is on separation, and I know the other guys have touched on that. Divestments can vary between disposals of self-sufficient business units, assets and operations that can integrate seamlessly into the buyer's operating model, and at the other end of the scale, businesses that have been built on years of acquisitions, complex operating models or shared service centres that are often intertwined across many functional levels. At this more complex end, it is common for the vendor to agree to provide some tax support for a limited period of time until the divested business can manage its own tax affairs. The mistake many companies make is not being specific enough around what that support will look like from a tax perspective, in the transitional services agreement. So, for example, what does it mean when the vendor says it will provide VAT or sales tax support? Does it mean they'll prepare the VAT returns or provide the data for the returns or answer questions if asked? Who will be responsible for reviewing the returns and signing them off? So post-deal problems can often be avoided with more careful consideration and wording in the agreements up front. And at that point, I'll hand back to Kirsty, who will take us through transitional services in a bit more detail. Over to you, Kirsty.
Thank you. Should we go to the next slide, Bex? So it's an area which is very specific to carve-outs and is often forgotten and left. People sort of come at it late, and they don't realise the level of detail that they need to review their own business to work out what needs to be provided going forward. Essentially, the transitional services agreement is what are we going to provide, for how long, and then the crucial question, for how much. And as you've seen from everyone talking through, it permeates every sort of area of the business. And what is true to say is it does what you're providing, for how long, and for how much does depend on the acquiring party. And very simplistically here in the diagram on the right-hand side, the sort of rule of thumb is a direct private equity investment into the business will need more support for longer as they gradually bring on the systems and back office, etc., that they need to, which to enable the business to run independently. Now, that might not work for you as a business because you're undertaking this transaction for a particular set of reasons, which is because you don't want to keep a particular property or an IT system, or you don't want your brand name associated with this area of the market anymore. So you need to think very carefully about how much you're prepared to do and for how long, and does the buying party actually impact any of those decisions. But typically, I think it's already been said, ideally you want transitional services for as short a time period as possible as a vendor, so that you can get on with your business's future and not have the distraction. The buyer may want some trail of transitional services and support because they don't know what they don't know. So you always have that tension within the negotiations about the period of time. Typically what you find is it's very intense at the beginning, and you have a step down as things are taken over by the buyer. If it's a team and it's literally slotting in, actually you might find that these things end up very, very quickly. But you can see things, and I have also worked in deals where the transitional services have continued for a couple of years. I'm not saying it's all of the time, but definitely needs to be borne in mind when you start on this journey. All of these areas need to be considered during that preparation phase, so that when you go to market, you can tell the buyer what it is you are expecting, and crucially, for how long and for how much. And it goes into, so there are lots of negotiations as you go through these deals. Simplistically, it's about day one cash and price, but actually, as John has already said, there are many negotiations to be had around the balance sheet and working capital, and actually then what are we going to do post-deal, and all of that package of commercial terms has to be negotiated together. So you don't want this to be left till last, because it'll get left out and you won't extract the right value for it. And I think that takes us on to the next slide, the sort of piece of how do you go about it. We've talked about preparation a lot today, but as with every deal, if you prepare well, then the next phases are much easier because you identify absolutely who the right buyer is. You can go to market and strategically negotiate the terms of that deal. And if you prepare slowly, we always say that you will then end up closing quickly. If you start in a haphazard way, what happens is that the deal and the process sort of unravels and becomes unwieldy, and it doesn't achieve all the things that you set out to do at the beginning in terms of getting rid of management distraction and all those sorts of things, because it can be all consuming. So a well-prepared business, we can package well, take to market, negotiate better, and then close quickly. And anyone who has worked on any transaction will know that closing the deal, especially in an environment where there's lots of unknowns going around, actually closing quickly and in an orderly way is fundamental to deal success and values achieved. And then to wrap it up, I'll just ask John to step in and summarise for us.
Thank you, Kirsty. Well, firstly, we hope our enthusiasm for carve-out transactions has come across today. Divesting of a business or asset can be a fantastic opportunity to create value. Carve-outs, by their nature, are complex and multifaceted, and as a result, are not considered as often as they should be, but are a great solution to generate cash. Key thing to note here is, though, that the rules for selling a non-core asset are exactly the same as selling any business. Your specialist RSM divestiture advisory team are here to support you, and our integrated service offering can help maximise value for you at every step of the transaction. And finally, thank you all for taking the time to listen to our webinar. I will hand over to our host Simon to coordinate any questions from the virtual floor.
Excellent. Thanks, John. Thanks, team. Okay, let's get on to questions for the next 10 minutes or so. Kirsty, at the top of the show, you mentioned the why now, the reason why to divest non-core assets, and you touched on the length of time that doing so might take. Are you seeing that length of time extend, and if so, by how much, because of the crisis, because of lockdown, etc.?
The answer to that, there's no hard and fast rule, actually. Prior to the crisis, we would have said that deal timetables were extending. We've had a number of uncertainties within the M&A market, not least of all the thing that we don't talk about anymore, but was all we spoke about last year with Brexit. And so the level of due diligence businesses are undertaking has definitely extended and was extending prior to the pandemic. Actually, though, I think some of that is a market dynamic in that private equity are much more diligence heavy, in my experience, than a pure corporate acquirer. That they have the rationale for the investing in and coming out, and the business plan, and the fact that the private equity house is a provider of money, not operating in the industry, means that they have to rely on more professionals to diligence typically than a trade buyer. However, if you are a well-prepared business and you have packaged and considered yourself and what you are selling, this asset that you're selling in advance, and you've taken a bit more time in terms of preparation as we set out today, actually you can go to market and close very quickly on the back end. We've just recently had a success ourselves where from offer to close was 6 weeks. That is fast, but it absolutely can be done. But the business was well prepared, and we've seen that. But the preparation is the piece that you must do, and it's always very tempting to dive into a deal just because you received an approach. But actually, what you need to do is take a step back and think, how are we in the best shape? And a good buyer will give you time to get ready to come to the table. It's actually a win for them. They don't sort of get dragged into processes, which is why we say, as John has set out, thinking about divestment as part of your strategy. It should be on the table all of the time, because the more you think about it, the more likely you are to be ready when it comes round the corner.
And I was thinking about just getting ready for it. I mean, traditionally, the identification of areas to divest from would have been the purview of the bean counters that might have identified non-performing areas. But I'm just trying to think about balancing that against the reimagining your business as part of coming out of coronavirus and thinking about investing in the future. You've mentioned private equity, and I know when we did the private equity webinar, Kirsty, Charlie Jolly was saying, look, there's a lot of money in the industry waiting to be invested. How much of an alternative is private equity in your experience?
It's not. I wouldn't say it's the alternative now. I would say it's the main part of the sandwich. So I think private equity will be leading the way in deals in the next 12, 18 months.
Yeah,
it'll be our first port of call.
Even though money is still relatively cheap elsewhere. That's
They have their money secured. And private equity has a requirement. It makes money not by, the fund itself makes money by investing it. It has to make capital returns. That compelling need to acquire is not the same for every corporate. It's the same as PE.
And Kirsty, Simon, I think there's a further facet there around private equity-backed trade. In an economy at the moment where organic growth may be limited to wider headwinds, inorganic growth through trade acquisitions will be a key way for private equity to accelerate the level of return through their investment business.
Yeah, good point. Whilst I've got you, John, a slightly more technical question. What is a locked box completion mechanism? And once you've explained it, can it be used on a carve-out transaction?
Sure. So there are two main ways of completing a transaction. One is a lockbox, the other is via a completion accounts mechanism. What a lockbox seeks to do is to adjust the purchase price, the headline purchase price, down to equity value with respect to debt-like items, cash in the business, and also normalized working capital, based on a historical balance sheet, i.e. a balance sheet that's known to everybody and can be diligenced as part of the transaction. One of the benefits of the lockbox is that both buyer and seller can get certainty over the equity value at timing of completion of the transaction. The alternative is a completion accounts mechanism that conceptually should end up with the same answer as a lockbox, but it's typically agreed 60 to 90 days post-deal. So although the headline price is known at the point of signing, the actual equity value, i.e. the net cash changing hands in respect of the transaction, won't be known. In terms of whether a lockbox can be used on a carve-out transaction, yes, it can be. Because you've got to get comfortable on a balance sheet prior to the completion of the transaction, we'd always advise the use of a lockbox from a divesture advisory perspective due to the certainty I've just mentioned. The key piece is to get people comfortable. So back to my earlier comments around setting the transaction perimeter and producing a robust set of financial carve-out information that can be diligenced by the purchaser's professional advisors mean that a lockbox mechanism can absolutely be used.
Okay, thanks, John. Carl, I think this one's a question for you. You mentioned considering the hive-out planning for essentially trading businesses where the vendor may qualify for the substantial shareholding exemption. What is that exemption? What if it was not available? What then?
Thanks, Simon. Yeah, it's a good question. So if you, let's say if you did have a pre-sale hive-down scenario where the vendor didn't get substantial shareholding exemption on the transaction. So that's basically, where they sell the shares and, the gain on those shares isn't exempt from capital gains. So let's having a think about that. Newco, when it leaves the vendor's group, would be liable to any market value gains on rebasing the assets that it's holding at the time when it leaves the group. So initially, I guess the buyers acquiring that risk. The vendor and the buyer can jointly elect for those gains to be transferred back from the Newco to the vendor. So that's by mutual agreement. And I guess where you'll end up there is the vendor will end up paying the tax anyway on the gain, and the buyer gets the step up in the base cost of the assets, and they get a clean company. I'd then actually question why they would do that when a trade and asset deal would get them to the same answer. Plus you're not having to get a tax covenant from the seller. Just to protect your position if the seller doesn't sign the mutual agreement at the 11th hour. So yeah, I think if SSE isn't available, it's probably trade and assets. Hope that answers the question.
Yeah, no, I'll give you that one, Cal. Thanks for that. But whilst I've got you though, just given the Chancellor's statement earlier today, just thinking about the autumn statement, the autumn budget, what one or two tax changes do you think the Chancellor could do to bolster transaction flow for the rest of the year?
It's an interesting one. I mean, today's announcements, you've seen he's reduced VAT from 20% to 5%, I think, for the hospitality and leisure sector. So that's obviously to try and protect the transaction flow into that sector. There is there's an element or almost kind of an anticipation that we may see some tax rises to try and increase the tax base to help I guess pay for a lot of the funding that's been made available. But that has to be handled quite carefully, because what they also want to do is still to continue to encourage investment into the UK, and an attractive tax system helps with that. And it has been the direction of travel over the the last few years, and particularly some of the benefits or the incentives that have been introduced around holding IP in the UK, for example. So I think we'll see a balanced approach here. So maybe some targeted some tax measures, but also some incentives to try and encourage more inward investment to help with increasing productivity, and that in itself then should hopefully increase the tax base.
Good, thank you. Thanks for that, Cal. Okay, just a couple of minutes. Let's try and do a couple more questions. Let's have a look. Michael, question from Michael. Welcome back, Michael. You've been missed, so welcome back. Charlie, I think you'll take this question. I think, what are the GDPR considerations and actions needed when transferring information? Let's start with you, Charlie, on a people information basis.
Yeah, thanks, Simon. Would always recommend that this obviously information relating to your employees will be personal data, and therefore you have to be careful about sharing that unless you've got consent from them. So in a transaction, you would normally anonymise that information. In a TUPE, where TUPE applies, there is, as I said, there is the requirement to provide the buyer with the employee liability information, which does actually require you to identify who the employees are, and that therefore may be a justification at that stage to provide that data. But you still need to be careful about what other data it is you're providing beyond that, because that's only a limited set of data, and therefore you wouldn't have necessary justification to do that. So the recommendation would be it would be anonymised until the point at which completion takes place.
Sure. Kirsty, anything you'd like to add to that?
So they're using anonymising data where if you're the business or asset, so the customer base is individual, and people records obviously have to be managed very carefully. So there's that has been actually quite a big change, even in the way that sales documents, etc., are written now. So being very careful about what do we have permission for, what details can be shared. So that needs to be managed. But actually, the commercials of a deal are often bigger than getting down to GDPR, so you would want to do it in any event. The actual, once the asset is sold, they're buying, that potentially that data and the assets and all the shares are bought, and the business is transferred lock stock. But what we do see and is increasing goes back to your previous point, Simon. So a review and due diligence of an entity's compliance and management of GDPR is a very large focus for acquirers, lawyers, in a way that it used to be data protection stuff used to be looked at, but now it's a real key area of focus in the diligence process. So with all these things, if you weren't absolutely I's dotted and T's crossed, you want to be before you go into a deal.
Yeah, absolutely. Well, I'm just conscious of time, everyone. I think we'll have to draw the Q&A to a close there. Thank you very much for your time and attention today. Can I just do one request from the RSM perspective? If you could just go onto the RSM website and make sure you just complete your preferences so we can make sure that we're sending you specific information relevant to your business and sector, that would be fantastic. And obviously, if you've got any questions that you want specifically answered relating to your own scenario, do go to our COVID-19 inquiries at rsmuk.com website. Kirsty, one final word from you. I'm going to give you the final word. What one thing would you say to a business owner listening in right now who might be sitting on the fence with regards to making a transaction or considering a carve out? What would you say to them?
Pick up the phone.
Perfect. Perfect timing. 3 o'clock. Thank you, Kirsty. Thank you, Charlie, Cal, John and David. And thank you all for your attention this afternoon. On behalf of RSM, we wish you all the very best to you and your businesses and success during and coming out of lockdown. Thank you very much, and we'll see you soon. Bye-bye.